Hey everybody, Courtney Smith here, and I got a question here I thought was a fabulous question, and I thought I would share the question and the answer with you. So let's dive right into it. So I bought the web page. By the way, we have it's like $7 or so. I don't even know what it costs, but we have a video for sale called "How to Predict the Stock Market 1 Year in Advance," which is a tremendous video. It's going to change your life. Okay, so he bought it. Excellent. This person is clearly a very intelligent person. Mr. Smith gave the speech or the video in March of 2019, and the yield curve showed flatter at the time. It was negative. Actually, it was negative at the beginning. I'll show it to you in a second. I saw the S&P 500 drop drastically in February of 2020. And remember, the video is telling you how to predict the stock market a year in advance. So in March of 2019, I put out a special report and I predicted that the stock market would drop in March of 2020, which it did. Now, however, he says, we cannot call it a bear market because the stock market rebounded and went up soon. Let's stop for a second. It was a bear market. It was down 36%. The definition of a bear market is a drop of 20% or more. So it was clearly a bear market. But then he says, but it rebounded quickly. All bear markets rebound quickly, except for just a couple, but usually V bottoms for bear markets. There are a couple of exceptions. 1973-74 was a much more of a kind of a cup bottom instead of a V bottom. Okay, but anyway, let's carry on. I think the drop was affected by the COVID rather than the bust situation. All right, now let's stop there. No, we were going to have a bear market anyway. The COVID was the trigger, was a trigger, but it was going to go down anyway. Everything in my original premise, which was called a financial crisis, occurred. So that was fine. Remember the COVID didn't cause the drop in the stock market or the economy. It was the government's response to COVID of quarantining healthy people for the first time in American history. Their policies are what caused the recession to be the way it was. But we were going to have one anyway. Every negative yield curve has led to a recession since World War II. This is no exception. Now, the government's response to COVID, of course, exacerbated the situation, but the market then rebounded very quickly, as it nearly always does after recessions. Let's carry on. The yield curve becomes more positive lately, no question. In fact, it became positive almost immediately after the crash hit in 2020 because the Fed then dropped short-term interest rates dramatically. Remember, they had been raising interest rates in 2019. That's one of the reasons why we had the negative yield curve and why we were going to see a recession and a stock market bear market in 2020. The Fed causes those things. So then the Fed dropped interest rates dramatically, which turned the yield curve positive. Now I'm going to show you pictures of all this in a second. He goes on, or he or she, I don't know. Does it mean the market keeps going up in 2022? Yes. But Mr. Smith has warned us of the debt crisis for a long while. Is the yield curve prediction not workable at this time? Does Mr. Smith give it further analysis or any additional update? Let's carry on. So here was the situation. Here's the S&P going back to the 1990s. And the yield curve was turning negative here before the crash. Okay, and there's the COVID crash right over there. And then there's the rebound. Let's take a look at it in a little bit more detail. So the yield curve turned negative back here in Feb, March, April of 2019. 1 year later, bang, 36% drop in the stock market, and then it rebounded and has been rebounding ever since. Why? Because the yield curve became sharply positive, and here's where it is today. The yield curve, short-term interest rates are far below long-term interest rates. So this says we're not going to get a recession. We're right now, as I'm recording this, in August 2nd, I believe it is, August 2nd of 2021, which means that at least from now until August of next year, highly unlikely we're going to have a recession. We had the recession in 2020. It did what it was supposed to do. You see, the cool thing with that video, and the video you're seeing here, is that when the market collapsed in 2020, the Fed immediately dropped interest rates. Now, the financial crisis is then stopped at that point because the debt is now sustainable. So if before I owed $100 and my interest rate, I'm just going to use round numbers, if my interest rate was $10, but I was only earning $9 a month, $9 a year, then obviously I'm going to go bankrupt. But if the Fed drops interest rates to zero, and now, after inflation, I'm not even paying any interest, then it extends the financial crisis out in time. The Fed had to drop interest rates, or we would have seen a debt catastrophe. The debt catastrophe is going to happen. The Fed's going to have to keep interest rates at super low rates for a long time to stop it from happening. Corporations are more in debt than any time in history. Governments are more in debt than any time in history. The consumer sector, the personal sector, you and I, was in pretty good shape, but now it's starting to get worse. It's still not at a crisis stage like corporate and government debt are. So the Fed has to keep interest rates super low. As soon as they start raising interest rates, which will flatten the yield curve, you'll see the stock market collapse again. In the meantime, it's a positive yield curve. Let's go make a bunch of money on the long side. Talk to you later.